Stock market investors are likely to face three major challenges this year, unique to 2025. The third one in particular could be the most crucial obstacle we'll need to navigate. So in this video, I'll break down each of them and explain why the decisions we make could be a turning point for our portfolios. But before we get started, a quick reminder that a lot of you watch my videos but haven't subscribed yet. So make sure to hit that subscribe button. It really helps out the channel. The first major issue impacting investors right now is interest rates. For the first time in decades, we are dealing with significantly higher rates than we've been used to. In the US, the Federal Reserve kept interest rates near zero for years, essentially since the global financial crisis. But as we know, the surge in post-COVID inflation forced the Fed to hike rates from 0% to around 5.2%. So far, there have been 3 rate cuts, bringing the Fed funds rate down to about 4.2%. But even with these cuts, rates are still much higher than what we've seen for most of the last 20 years. The reason I'm talking about US interest rates is that the US stock market dominates the global market, and the S&P 500 is often seen as the market benchmark. So any shifts in US interest rates will directly impact the S&P 500. And since most UK investors likely hold an S&P 500 ETF in their portfolios, these changes matter more than you might think. And why is this important? Because interest rates directly affect bonds, which act as a benchmark for valuing all other investment opportunities. How does this work? Well, when interest rates rise, the return on bonds increases. Conversely, when interest rates fall, the return on bonds naturally decreases. Bonds are considered very safe in the investment world. This means that when interest rates rise, big institutional investors such as pension funds, hedge funds, and investment banks are more likely to move their money out of stocks and into safe short-term bonds. Right now, that's actually a fairly attractive option, with yields around 4.2–4.3%. It's not a huge return, but for the low level of risk involved, it's a solid deal. What this generally means is that high interest rates can be a tough time for stock market investors. This is because as more money flows into bonds, there is less demand for stocks, which can drive their prices down. Also, high interest rates make it harder for businesses to secure financing to grow. For companies that have a lot of debt, when that debt needs to be renewed, it costs them more to pay it off because of higher interest rates. And one big concern for stock investors in 2025 is that if inflation continues because of things like global conflicts, tariffs, or political tensions, interest rates might stay elevated for longer, which could put extra pressure on businesses. That said, this is a really interesting topic because despite these tougher economic conditions, we haven't actually seen a massive tightening of stock market valuations so far. In fact, the S&P 500 rose by 23% in 2024, building on a 24% increase in 2023. But the point is that there is still concern about persistent inflation, which is likely to keep interest rates high for longer. This in turn could put pressure on business performance, as higher borrowing costs and tighter financial conditions may slow down growth and profitability for many companies. At the same time, the US government is facing the challenge of refinancing $9.2 trillion of debt this year, with 70% of it due in the first half. The rising debt and pressure to refinance could affect the market in ways we haven't really seen before. Some even argue that the government or the Federal Reserve could be allowing a recession to happen in order to bring down inflation and lower interest rates, making it easier to refinance debt. With all of this in mind, many investors might start to wonder if this time really is different, leading to a temptation to speculate on where the market is headed next. So the big question is, what should we do about it? Especially here in the UK? Well, before we answer that, let's dive into the second major challenge for investors in 2025, overvaluation. Now, what's interesting, though it doesn't really make much sense, is that even though interest rates are higher, most big American companies aren't really struggling with their valuations. In fact, despite these higher rates, the valuations of American businesses are actually soaring, especially among these so-called Magnificent Seven companies. As I mentioned earlier, the S&P 500 rose 23% in 2024 and 24% in 2023. That's a total rise of 50% in just 2 years. If we look at the S&P 500's price to earning ratio, which is just a measure of valuation, it currently stands between 26 and 28 times earnings. Now, while this isn't quite as high as the peak of the dot-com bubble, it is pretty high by historical standards. So why is this happening? Well, despite the high rates, investors remain optimistic about long-term growth, especially in the tech sector. There is a lot of confidence that these big companies, like the Magnificent Seven, will continue to dominate in the future, making them worth the higher valuations. On top of that, even though interest rates are high, they're still not high enough to make bonds and other safe investments overwhelmingly attractive compared to the growth potential of stocks, especially in these big tech companies. This combination of optimism and market momentum is pushing stock prices higher, even though we're kind of experiencing a correction at the moment, keeping valuations elevated. This seems odd, right? Given that higher interest rates usually push people away from stocks and towards safer investments like bonds, which offer decent returns, it's a bit surprising that stock valuations are still rising. The reality is that for now, the appeal of growth in these major companies is outweighing the safer, more stable returns from bonds. And this is a key reason why we're seeing such high valuations, despite the higher interest rate environment. That brings us to the question, what should you do about it? Well, there are really two parts to this answer. The boring one is that you don't do anything at all. If you're an index fund investor with a strategy to invest in the broad market, there is not much to change. You just stick with your plan and ride it out. The second part of this answer is a bit more complex. But before we dive into that, I think it's important we discuss the third and probably most crucial challenge investors are facing this year: the temptation to speculate. In 2024, it was clear that greed and hype were running rampant. Share prices skyrocketed, often far outpacing actual business performance. In these kinds of environments, especially for newer investors, FOMO, or fear of missing out, can be incredibly tempting. If you're not careful and stay on top of your emotions, it can push you into speculating on overhyped, expensive stocks, rather than sticking to rational long-term investments. When everyone starts speculating, it creates its own kind of reality for a while. People speculate, which drives up stock prices, which then encourages even more speculation, pushing prices even higher. Sure, this can make you some quick money in the short run, but over the long haul, it's one of the most dangerous habits you can fall into. So the challenge in 2025 is to train yourself to avoid speculation, because this could be a turning point for your investment portfolio. The thing is, all this increased speculation in the market might feel frustrating for long-term investors, especially since everything seems to be inflated. But it's not all bad for those of us who are in it for the long haul. The reality is we can take advantage of moments when the market drops, often driven by panic selling, and buy at lower prices. So for most of us with smaller portfolios, when something goes wrong and speculators shift from greed to fear, sending stock prices plummeting, you can quickly jump in and take advantage of the situation, or just continue pound cost averaging through the ups and downs. So to sum everything up, investing in 2025 is going to be challenging because there are three key themes to navigate. First, interest rates are higher, making bonds more attractive than they've been in a long time. Second, stock market valuations are high. And third, speculation is everywhere. So what should we do about all of this? How can we position ourselves to navigate these challenges while staying focused on long-term success? Well, first of all, when it comes to higher interest rates and attractive bond yields, the straightforward answer is that if you want to diversify and hold some bonds, there is nothing stopping you. Some long-term investors choose to keep a small percentage of their portfolio in bonds for stability, especially as they get older. In times like these, bonds can provide a cushion. That's why some investors, particularly those with shorter time horizons, turn to them as a hedge against volatility. For someone with 20 or 30 years ahead, staying focused on a stock-heavy portfolio and tuning out short-term noise remains a tried and true strategy. When it comes to investing in an overvalued market, there is really not much we can do as long-term index investors. The key is staying focused on diversification and sticking to a consistent strategy. This approach is simple, but it's effective, no matter what's happening in the market. Instead of stressing over whether stocks are too expensive, continuing with your investing schedule helps minimize the impact of market fluctuations. Remember, valuations can remain elevated for a long time, and waiting for a crash could mean missing out on further gains. The most important thing is to stay invested and keep your focus on long-term growth. Lastly, when it comes to speculation and the FOMO-driven investing environment, the biggest challenge is avoiding emotional decisions. It can be tempting to chase high-flying stocks or jumping into whatever's trending, but history shows that market manias don't last. Instead, long-term investors should stick to their strategy, continuing to invest in broad market ETFs and resisting the urge to make impulsive trades. Over time, markets go through cycles, and those who stay disciplined tend to come out ahead. So how you navigate these challenges this year, whether it's managing interest rates, high valuations, or resisting the temptation to speculate, could very well be the turning point for your portfolio. In fact, ETFs are taking a hit right now due to the stock market correction we're experiencing. So the immediate test is how you react to it. So check out this video next to see what I'm doing.